Hey everybody. So, all right, my name is Daniel Young. I'm the owner and founder of Adaptive Perspective. I believe it's my purpose, my calling to help you identify your dreams and help you reach your financial freedom destination and maintain it so you can pass your wealth off to the next generation. If you've seen any of my past videos, you understand our investment strategy using closed-end funds. And understanding that strategy is key because I'm going to apply the strategy towards sifting and filtering out financial memes. Most of the memes will be trash, though I have found some decent ones here and there. So reminders, this is an unedited video. Who knows what you'll hear in the background as I film these in my house. And currently, my wife is prepping dinner. So maybe you hear that in the background. If I show our strategy of using closed-end funds, if I show our master, I'll briefly walk through what I show you. Disclaimers. See the see the description for the full disclaimers. The only one I'll mention here is the following: that I am not a financial advisor. I'm a financial strategist. This is not a closed-end fund review. Uh, I still do those, but this isn't that. I'm talking about filtering financial advice you see on the internet at large, which does include this review, Pinterest, and then all those pretty financial memes we see floating around. If you've been watching my videos, you know what I'm about. The purpose and methodology behind our investment strategy, and then using that knowledge and the continued growth of knowledge or wealth of knowledge allows me an easier ability to sift through all the supposed knowledge floating around the internet. Now, my goal isn't to just trash people. I will use our lens to call out crappy memes and bad advice, but I'm not going to outright trash people who put the information on the internet. I'm not out to slander anybody. I am interested in separating the good from the bad when it comes to financial advice because none of us want bad financial advice. So let's move past the general script and get into the overall review. And in order to do that, I need to share some screens. So, all right. So I'm doing this a little bit out of order. Generally, I start at the end of our Pinterest financial meme board and work my way up. But I'm breaking that tradition because this is currently floating around Facebook, and I'd much rather address it while it's current than months later when it's not current. So this is floating around Facebook. Um, and this picture is not the only picture I've seen with this advertisement. So their suggestion or their meme is 36 dividend stocks, and then you get dividends every month. And some of these you can figure out the company for. Some of them you have to know the ticker for. So looking at this, I went through one of our closed-end funds and identified shared funds. So shared between this list of 36 and that one closed-end fund. And I found 12 shared stocks. Now, the ones that I picked just so happen to be quarterly, um, which means, let's see, I picked, so Bank of America is a quarterly dividend, and it, without looking at when it pays at, so two, three, one, two, three. So based on here, if it pays quarterly and it pays routinely on the third month of the quarter, it would also pay you in March, and then it would also pay you in September and December. So it's kind of redundant, pending strategy. But if all of these pay quarterly, and I don't know how all of them pay, but I know for sure that Bank of America's pays quarterly, and MasterCard, P&G and Visa pay quarterly. Coca-Cola pays quarterly. Depending on when they pay, you've got all this other stuff paying at the same time. So it just looks like it's paying for June alone, but it's also paying in these other months. So that's a little deceiving. But in looking at the actual breakdown between this and one of the funds we own, that's our actual master list, is this. So we'll get to the one fund we own, but let's look at some of the data between, we'll say, some of the visual data from that 36 stock list. So let's see. Merck and Company is that. And I knew because I really just went through this entire list of funds, which this is just the top 20. But I went through every single fund in the portfolio and looked for their image and found their image and compared that to these images. So Merck and Company quarterly cost, this net asset value pertains to closed-end funds. Closed-end funds operate on a limited shares or closed shares list, meaning that they have a set number of shares and it's straight supply and demand. So when demand goes up, right, and shares decrease, then stock price goes up. And when when demand goes down and number of shares increase, then price goes down. All of these companies are not closed-end funds. So if they ever ran out of shares, they can simply pluck another one out of thin air, write a share for you, and it does nothing to the overall cost of their fund. So I looked at their dividends. Generally, I do this based on $100 invested, but because some of these cost so much a share, like Microsoft and MasterCard, I had to increase it to 400. So look at how many shares you can buy for $400, and then how much dividend you get off the $400, and your annual yield. Now, inflation is currently 4%. So the age-old advice that I hear, see, Apple is not on this list. We'll look at Microsoft. So any of these companies, if any of these companies go up 10% in 5 years, like in 5 years, it'll go up 10%. Well, that's great, but it's costing you money every year just based on inflation. So that, especially MasterCard, let's say MasterCard goes up 10% of its current value, plus in 5 years, it's 416, right? It's gone up 10%. That's not that much money overall, right? But every year it actually costs you 3.4%. So 17 compared to, let's go back, get another calculator. So 379.04 times 10%, $37. You're getting a $37 increase, but you're actually losing 17%. So you got a 10% increase and a 17% decrease in the overall value of your money. That's not a great deal. So if you look at all of these companies for just one share, right, how much you can invest just based on $400. So 3 shares, 1 share, right? I'll let you go through it. Feel free to pause it and actually look as I scroll across. So if we, yeah, and they all pay quarterly. I didn't look to see which quarter they pay in. But if you invested 1 share into all of these 12, it would cost $2,100 or $2,158.43 for just 1 share of all 12 of these. Right? Here's what one dividend would get you, or the annual dividend would get you, right, off that 1 share. And here's what it would be off $400, which would just give you cost of 1 share. Yeah. So your annual yield off this number and that number is just 1.78%. with inflation at 4%. So you'll make just under 2%. And at the same time, you'll lose that because inflation is at 4%. Versus you could buy one closed-end fund that has all 12 of these plus more, meaning, let's see. Yep, there it is. And I've done this on a different video. I've shown every single fund they own, but you can look through this. You can pause the screen, right? And you can see all the different brands that are housed inside this one portfolio. It really is like a portfolio in a can. Now, let's see, we closed that. That's our closed-end fund master. There we go. So this is based on Friday's numbers at market close. So the cost of one share, the dividend for one share, the annual dividend doesn't look like a lot overall, but for $400, you can get 63 shares and you would get almost $38, which gives you a 9.5% dividend or a 9.5% yield. Now, if you're going to buy all of these for that amount of money, let's see. That's not going to work. So let's calculate this again. So 2158.43 divided by, and we'll get to why this is black. Right? If you were going to spend all of that on just one share of those 12, you could take the same amount and put it toward just this one fund. So divide it by and get 342 shares. That goes here. Now you get a little over $205 for the year. Well, 340. Let's see, times 4. Annual dividend times 4 times, oops, times that. Nope. 4 times that. There we go. You get 205 for the year. Yeah, it's the same, off 400. So that's the dividend off one share, right? For $400, you would get $205, which is a lot more than $84. And it pays quarterly, but it's an off pattern. It's 1369. And let's see. Yeah, it's been known to pay higher. Right. But the last 3 quarters, it's paid 15 cents. Now, USA is a good deal. I mean, is it double the historical average, or say double the historical average discount? No. Is it double the 5-year discount? No. But it rarely goes on discount. So here, the last 6 months, right? But the last year it was actually selling for a premium, meaning selling for more than it was worth. Currently, it's selling for a discount. The last 5 years, it's been just under 1.5. It's currently like 0.79. Yeah, 0.79. So it's not quite at the same discount. If we look historically, no, it's not double the discount. So it makes our individual list, like, yes, we own it, it would make a dollar cost averaging list, but it's not the most, say it's a great fund, and I'm not taking anything away from that. But there are better deals based on the discount compared to USA right now. And USA really does that portfolio in a can. So if we look at a different portfolio in a can, this Furtis fund, or ZTR, which we'll show here. So these are the top 10. Now, having gone through their portfolio compared to this portfolio, I found two funds that are direct comparison. American Tower, and I want to say Apple, but I don't plan on showing you everything. But if you look at Virtus online, you can find their complete portfolio, and it's a portfolio in a can. It is government securities, bonds, foreign government securities, mortgage-backed securities, non-agency securities. Let's see, and they own a lot of interesting stuff. Credit Suisse, Hilton, Home Partners, JP Morgan Chase, Palisades I've seen before, Starwood, yeah, UBS, Wells Fargo. We get asset backed, so auto stuff. Maybe I will go through their whole portfolio. We get other stuff, so Arby's funding, Tom's, Diamond Resorts, FAT, Hardee's, Jack in the Box, Jersey Mike's, Taco Bell. Yeah, all fast food and all competitively priced fast food. Lumen, that would be three. Say three in relation to this group. Twitter, At Home, Caesars, Dick's, Ford Motor, MI Homes, Pulte Homes, Under Armour, Weekly Homes, BAT, Turning Point, Antero Midstream, Energy Transfer, Kinder Morgan, Occidental, State Oil, Target Resources, Transocean, Allstate. I'm just picking out the names that draw my attention. Bank of America, Bank of New York Mellon, Broad Street, Charles Schwab, Liberty Mutual, MetLife, Prudential, Wells Fargo again. Yeah, I mean, they have everything and the industrial stuff. So Alaska Airlines, American Airlines, Boeing, British Airways. They've got a little bit of everything in here. So it truly is a portfolio in a can. Does it have all of those 36? No. But it's got some of them and it has a lot more than just the 36 and it pays monthly. So if we reset this value, so ZTR really is a portfolio in a can. Like it's got a little bit of everything. Pays you monthly. That's the price. It's currently at discount and it is a very good discount. So if we're looking at double discounts, so at 5 year, it's 3% off. Means like, so instead of paying a full dollar, you're paying 97 cents. But if we look long term, so it's selling it, yeah, almost 10% off. So instead of paying a dollar, it's like 90 cents. Yeah, it's still a good deal long term. And ZTR kind of has this swinging bounce pattern. Someone I read calls it a moonshot. Like if you can beware the swing or beware the lull, right? Like overall here, yes, it's gone up. But if you look every 2 years, it's kind of got this little bounce effect where it really does bounce between highs and lows. And currently, right, so 20, 22, another bounce. And we're currently in that lull, in that reset mode before it swings back up. So if you're going to buy low and sell high and play the bounce, that's great. If you're going to hold it long term, so you buy low, watch it go high, come back down, buy low, watch it go high, come back down, buy low. It pays a consistent dividend, right? Went a little quarterly, but then since COVID and all, it has paid a fairly consistent dividend. And we're back inside that reset bounce mode between the next upswing. So if we go back, so it pays monthly, right? Historical buy alerts pays 8 cents a share, which doesn't look like much, but when you put it in perspective, it pays a lot. And off of $400, it'll give you 65 shares. If we do the math, so off of 351 whole shares, I get 336, right? That's a good deal. Like that's a really good deal. Actually, I can double check my math on the spreadsheet. So this is our master. This is the video I did yesterday. Right. So these are the closed-end fund reviews for this week. Not ratings on company, but rating based on what I would buy pending money right now. And if you want to watch that video, that's in the portfolio tab. So if we bought 351 shares, it would give us that amount of total investment and that for the year. Yep. So you get monthly dividends. So if we go back to here, so you get $28 a month all year long, right? So you get consistent dividends paid monthly all year long. You get a better dividend than this portfolio when it can, and you get a much better dividend than this mess of things. So if you want to buy individual stocks, go for it. If you're buying it based on speculative investment, meaning you're buying it today based on what you think it'll be worth 5, 10, 15 years from now, you can. You just need to understand that the dividend it's paying you is not meeting the current inflation level, which is eroding your investment and eroding your wealth because you could gain like this, you could gain 10% in 5 years, but at the same time, you'll lose 17% in 5 years. So you've actually lost 7% waiting for that value to go up. And you've got, it looks pretty like I've got a decent reward for owning that company, but you really don't. So Should you put all the eggs in this basket? No, because it is that moonshot play. Like we're looking at that down and bubble up and down and bubble up and down and bubble up. So whether you call it a moonshot or a bounce or a swing really doesn't matter, right? Should your whole portfolio be this? No, but you could split value even between these things and get a better outcome than just single stocks. So if you're investing in only single stocks, I challenge you to try to look at it from a different perspective. I challenge you to do the research on closed end funds, right? Watch my videos where I break everything down. And then also do your own research. You can find my Facebook group called Adapted Perspective Navigate Your Finances. It's got the same banner as this page of this channel. And go there, see what you think, yes. But then on the files tab, there's a file called Stock Market Terminology, where I look at, I won't say basic, but I start basic and get into some other things. And then I break down just the Coca-Cola portfolio, just the Coca-Cola portfolio and quarterly amounts, all that, and compare it to USA. And use different time, like use the correct terminology as I go through stock market terminology, break it all down, and do the research and learn more and see if this closed-end fund system is a much better thing for you than single stock investments. I won't I won't vouch and say that we own all of these funds through our closed-end funds, but we own a lot of them. And they're broken down, pending fund, they're broken down into monthly and quarterly payments. We have some great quarterly payers, but honestly, I like the consistent monthly dividends. So my goal has been, which I'll admit that we currently have 3 category 3, so they pay that third month of the quarter. So 3, 6, 9, 12. We have 3 current category 3 dividends, but at the same time, I would like to cut that down to 2 and go 1 to 2 per category, so that we go 1 to 2 per straight category 1, 2, 3. So when they pay, we have 1 to 2 mixed, meaning they don't pay on a straight category alignment like USA pays 1, 3, 6, 9, and then the rest is all monthly based to where our portfolio stays at 25 or less. We cycle through and sell. Like it's not a set buy and hold for life. Some we sell, some we buy and hold short term. Some we do have, marked as lifetime, but we've got some that are sell at 20%. We have some that are sell at like kind of like a long-term hold. ZTR would be a lifetime thing, but at the same time, we're not going to always buy it because it's going to be based upon the overall price. So we could swing trade it, meaning like buy it low, sell it high, right? Wait for it to drop, buy it low, sell it high. Or we could buy it low, hold it as it climbs, get paid that consistent dividend all the way through, let it come back down in 2 years, buy it again low, right? So we can buy, let it go through, buy, let it go through, buy, and get that consistent dividend all the way through, or pending the market, right? So it's here. So buy, wait for a year and a half or so, sell it, let it come back down, buy it, sell it. So it kind of depends on your strategy, but you're not beholden. You're not in that must do buy and hold and never sell thing. So without getting into everything related to this master list of things, just want to show like our hold time of things. Like IGR is a lifetime. AOD, not happy with the company of how things are going, earmarked for sale at 20%. So far, this is marked for sale at 20%. We'll see if it changes. NML is based on oil and natural gas supply. So supply and demand. So long as oil and natural gas are say in heavy production projected for at least another 30, 40 years. Pending market and overall, it's long term. Now, say I'm in my early 40s, maybe that turns into a lifetime thing if it carries on for 40, 50 years. But then now it's my daughter's time to figure out if she wants to sell it or not. Versus this bond company for the Pacific Rim is a lifetime thing. I mean, regardless of what it's worth, like that's our average buy-in price right now. Compared to that, yeah, overall we're down 20%, but based on dividends, we're just down 9%. But whether it's this price or less, and it's been less, right? Or whether it's this price or more, we're going to hold this fund. And you can see what we've sold. I'll swing over and show you when we sold all of that stuff. And then I just took this money and reinvested it into something else. So based on if you're doing single stocks, you need to know what you're investing in and not just knowing because this group says they're great investments or knowing because, hey, that's going to be a really good deal as we go forward into this AI technology push, right? You need to know how you want to invest for you and what works best for you. Because for me, this does not work well. I love how this works. So I will leave it there. If you like the content, consider subscribing to my channel, and then also head over to Facebook and join my group there called Navigate Your Finances, and the link will be in the description. So as you face this stock market investment strategy, whatever you're going to use, okay, remember that you make your choices, and regardless of how that goes, you're the one responsible. Right. So I say this every single video, whether I'm doing memes or our stock market portfolio, or sometimes I say it on my Facebook group lives. It's you're the captain of your ship, right? You're in charge. You're going to direct that ship where it goes. Okay. You have the power to change your life and financial future. Many people will offer to help you, but only you can make the choice to do it. So make it happen. If it would have happened already, whatever you're going for in your investments, through your earned income, if you're looking into passive income, whatever it is you're trying to do, if it was going to happen on its own, it would have already happened, right? But it hasn't. So do the work. So make it happen. Shock your world. This is Daniel Young signing off. I will see you all on the next video. Bye-bye.